Welcome to the deep dive. You've given us quite a pile of sources here, all looking at HDFC Bank's Q2 FY26 results. It's a lot to sift through.
It is, and our job today is really to cut past those headline numbers, find the real strategy underneath.
Because the initial figures, they look pretty decent, don't they?
They do. I mean, standalone net profit after tax, that's $186.4 billion. It's up 10.8% year on year.
Solid growth.
Yeah, and net revenue also climbed 10.3% YoY to $459.0 billion. So volume expansion is definitely there, as you'd expect.
But like you said, that's the surface. The real story, reading through the management commentary, feels like a very deliberate choice they're making.
What's that?
Well, it seems they're sacrificing some margin right now to get the balance sheet right for the longer term. Post-merger rebalancing,
Exactly. The fight for deposits, managing that loan-to-deposit ratio, that seems to be the core focus, even if it means some short-term margin pressure.
So the quarter wasn't just about profit numbers. It was about managing that pressure from the interest rate cycle.
Precisely. Margin compression was kind of the elephant in the room they had to navigate.
Okay, let's unpack that then. Net interest margin, or NIM. What happened there?
Well, net interest income, the NII, it grew, but only by 4.8% year on year. Came in at $315.5 billion.
Okay, slower than the overall revenue growth.
Right. And the core NIM on total assets landed at 3.27%.
3.27%. And how does that compare?
That's the key point. It's down from 3.35% just in the previous quarter, Q1. So a noticeable decline.
And why did management say that happened?
They were quite clear. It's because assets repriced downwards faster than their funding costs came down.
The classic timing mismatch.
Exactly. If you look at the yields, the yield on assets dropped pretty significantly, actually, from 8.3% down to 7.8% year on year.
Okay.
But the cost of funds, while it did improve, only moved from 4.9% down to 4.6%. So a much slower adjustment on the liability side.
So earning less on loans faster than they're paying less for deposits. Makes sense. Did they give any indication of when that might balance out?
They did. They gave a specific timeline, which is interesting. They said, while savings account rate changes are factored in quickly, the changes they made to time deposit rates, cutting them by maybe 70, 80 basis points, well, that takes about 6 quarters to fully reflect in the margins.
6 quarters. It's quite a lag.
It is. But the flip side is, assuming rates stay stable, they're expecting maybe 4 to 5 quarters of tailwinds still to come, which should help margins recover.
Okay, so the current pain is understood. It's temporary, and there's a predictable path to improvement baked in. That's useful context.
Absolutely. It shows they're managing through a known cycle.
Now, while the interest income side faced pressure, the non-interest income seemed to provide a bit of a cushion.
It really did, a significant boost, actually. Other income saw huge gains in net trading and mark-to-market, reported $23.9 billion there.
Wow, compared to what?
Compared to only $2.9 billion in the same quarter last year.
Okay, that's a massive jump, almost 10 times.
Yeah, and fee and commission income, which is maybe more stable, also grew healthily at 8.5% YoY.
So that trading gain definitely helped the overall revenue number. But how sustainable is that kind of gain? Is it just, good market timing?
It's definitely less predictable than core fees, you're right. We should see it as somewhat opportunistic. But the important thing is, even if you mentally strip that out, their underlying efficiency looks good.
How so?
The cost-to-income ratio was managed tightly. It came down slightly to 39.2% for the quarter, from 40.6% a year ago.
Okay, so they are controlling costs and getting some operating leverage. Good.
Suggests those past investments in efficiency are starting to, kick in.
Right. Let's pivot to the balance sheet then. Loan growth. How did that look?
Still strong momentum. Gross advances hit $27,692 billion. That's up 9.9% year on year.
Almost 10% growth.
Yeah.
Where'd it come from mainly?
It was pretty broad-based, but commercial lending really stood out. Small and mid-market enterprises, SMEs, they grew a huge 17.0% YoY.
17%. Wow.
Yeah. And corporate and wholesale loans were up 6.4%. Management specifically mentioned they were active in working capital financing there, which they find profitable and, crucially, short-term.
Okay, so capturing business demand. But connecting this back to the margin discussion, funding all that loan growth, that's the challenge, right?
That is the absolute core strategy piece right now, the funding imperative.
So how did deposits grow?
End-of-period deposits grew 12.1% YoY, hitting $128,018 billion. Average deposit growth was actually even higher at 15.1%.
Okay, faster than loan growth. That's good.
It is, but you have to look at the mix. The TESA ratio, the cheaper current and savings accounts, that held steady around 33.9%,
Which means?
which means the faster growth came from term deposits. They climbed 14.6% YoY.
Ah, so they had to pay up more for those deposits,
Right.
reflecting that competition for funds.
Exactly. It shows how intense and frankly expensive mobilizing funds is across the whole system right now. And this brings us straight to that metric everyone's watching. The loan-to-deposit ratio, LDR. Where did that land? It stood at 98% for the quarter.
98%, that's
Yeah.
still quite high, isn't it? Especially post-merger.
It is, and management knows it. They explicitly reaffirmed their strategic goal is to get that LDR below 90%.
Below 90. How are they planning to do that? Just slow down lending.
No, the opposite, actually. They aim to grow deposits faster than the overall system loan growth next year in FY27. They want to gain market share on the liability side specifically to bring that ratio down.
So grow deposits faster than loans and faster than competitors. That's ambitious.
It's a huge undertaking, like you said earlier, turning a supertanker, but that's the strategy. Accept the margin squeeze now to achieve that crucial long-term balance sheet stability.
And they can afford to do this because their capital base is strong.
Exactly. Their capital adequacy ratio, CRR, is very robust at 20.0%, and the core equity, the CET1, is 17.5%. Plenty of buffer.
Okay, that makes sense. Now, asset quality. This seemed like a surprisingly positive story this quarter.
It was. On the surface, the gross non-performing asset ratio, GNPA, dropped quite significantly, down to 1.24%.
From 1.40% last quarter.
Right. Yes. And net NPA also improved. Slippages, which are new bad loans, were also down, so the portfolio looks healthier.
I sense a but come in.
Oh, yes. You have to read the fine print. Management disclosed something important. About 10 basis points of that big drop in the GNPA ratio was due to a single large upgrade. An account that was previously classified NPA had performed well for 2 years, so it got upgraded.
So a decent chunk of that improvement wasn't, let's say, organic improvement across the whole book, but a specific one-off event.
Correct. It slightly tempers the headline number, makes the underlying improvement maybe a bit less dramatic than it first appears.
Does it change the overall picture of resilience, though?
Not necessarily, because despite that headline improvement, the bank actually chose to increase its provisions, its safety buffers.
Even though NPAs went down.
Yes. The specific provision coverage ratio was kept high at 67%, but the really striking figure is total provisions, specific, floating, contingent, general. They now represent 211% of gross NPAs.
Wait, 211%? What does that actually mean for the listener? That sounds enormous.
It's huge. It means for every dollar they might eventually lose from a declared bad loan, they have more than $2 already set aside in various safety pots.
Okay. Extremely conservative.
Very. And on top of that, they made an additional floating provision of 90 billion, that's 9,000 crore, just in the first half of this fiscal year.
A floating provision, what's that for?
It's not for any specific known bad loan. Management said it's for unknown and unforeseeable risks. Basically, they're building an extra cushion just in case. It really underscores that focus on stability over maximizing every penny of profit right now.
That conservatism definitely fits the narrative of prioritizing long-term stability. Okay, let's shift to the future then. Investments, merger integration, and tech. Where are they seeing progress?
The home loan integration seems to be bearing fruit quite clearly now.
In what way?
Mainly speed. They highlighted much faster turnaround times, T80 for loan sanctions, down to just 2 days for individual loans, 3 days for self-employed.
That's quick. Speed is definitely a weapon in the mortgage market.
Absolutely. And the whole point of the merger was linking that mortgage engine to cross-selling other products, right?
Yeah. How are those cross-sell numbers looking?
Actually, remarkably high based on their early data. They're getting savings accounts attached to 98-99% of new mortgage customers.
Wow, almost everyone.
Yeah. Credit card penetration is over 14% and brokerage accounts over 15%.
Okay, so that integration plumbing seems to be working. They're successfully funneling banking relationships through that mortgage door.
It certainly looks like it from these early metrics.
And the other big investment area is technology. They mentioned Gen AI. What's the strategy there? Is it just about cutting heads?
They were very specific about this, actually. They stressed the AI investment is strictly for process re-engineering, making things faster, improving the customer experience, creating that wow factor, as they put it.
Not job cuts.
Explicitly not for job cuts. They framed it as capacity release. The idea is to free up people from back-office processing tasks and move them into front-end, customer-facing roles.
Interesting. So they still see the human element as key for growth.
Apparently so. They believe that engagement is crucial.
Okay, so let's try and wrap this up. If we summarize this deep dive into HDFC Bank's Q2, we saw decent profit growth, yes, driven by loan volumes,
And helped along, opportunistically perhaps, by that non-interest income boost.
but the real theme was strategic patience, wasn't it?
I think so. They deliberately took a hit on margins in the short term.
To focus squarely on that big long-term goal of rebalancing the balance sheet, getting that LDR down below 90%.
Right. And while doing that, they kept investing heavily in distribution, technology, and leveraging those early merger wins, particularly in home loans.
They're clearly setting the stage, positioning themselves for what they hope will be faster than market growth starting next fiscal year, FY27.
That seems to be the plan.
So the final thought then, for you the listener, the bank's current return on assets, ROA, is around 1.9%. We heard there's maybe 4 or 5 quarters of margin tailwind coming from deposit repricing. They're investing heavily in tech. Integration seems to be working.
So the big question is, will all this, the integration benefits, the tech investments, that expected margin recovery, be enough to push the bank back towards its long-term goal of an ROA consistently over 2%, especially when competition in lending isn't going away? That's the multi-billion-dollar puzzle they're working on solving right now. Can the strategic investments overcome the persistent competitive pressures?
Something to think about. That's it for this deep dive. We'll see you next time.